It's become clear that the 1.8% estimated growth in US GDP this year is almost 100% composed of large tech companies spending on CapEx related to, of course, AI, which means that the rest of the US economy is barely growing. This is a tale of two economies, and the impact on people's lives is real and cannot be overstated. Kids went into computers because that was where the jobs were, and now AI has unfortunately done a bait and switch on all these young people, which is just so upsetting. Some of the massive AI capex is hit and miss, with a lot of very expensive misses and a lot of unintended consequences. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. This is for the week ending October 10, 2025. This week, markets reached all-time highs again, but the major news was AMD making a deal with OpenAI, and the US government remaining shut, and gold reaching $4,000 an ounce for the first time ever, and those three items were this week's major news events. There was one more piece of news I want to flag. Fifth Third, a regional bank, bought Comerica, thereby putting Comerica shareholders finally out of their misery. At the purchase price of around $80, Comerica is only $10 higher than where it was in 1998. I am convinced that the Trump administration is going to encourage a new M&A wave in regional banks. This is just the beginning. Next week, earnings season begins in full force, and I will once again go through earnings results in some detail and give you my takeaways. This week, I'm going to clean up the mailbag as much as possible. We've gotten a ton of questions and comments. It's become clear to me that the 1.8% estimated growth in US GDP this year is almost 100% composed of large tech companies spending on CapEx related to, of course, AI, which means that the rest of the US economy is barely growing. I'm going to repeat that statement. This is a tale of two economies, and the impact on people's lives is real and cannot be overstated. From the investment point of view, right now, there is just an incredible AI capex feeding frenzy, feeding bullish sentiment. But long term, those expenditures must generate very strong returns on investments in order to justify themselves and their stock prices. And that could happen. But right now, it is still so early in the process that anyone can literally say anything on this topic, and tech stocks remain, of course, in favor. So I'm going to start the mailbag by focusing on the actual impact of AI on real lives by reading a letter from a software developer listener. In his letter to me, he expresses his skepticism about the potential benefits of AI and the enormous burden the huge CapEx investments are placing on people's lives. Although it's a bit long, I think it's really worthwhile to make the theoretical personal by reading it to you. This is from Max. Subject, AI bubble reality check. He writes the following. Hey, Steve. I won't be surprised if you don't have time to filter through what I can only imagine is an ocean of junk emails like mine, so no worries. Well, we're going to read his email. I've been a software developer for over 10 years in many kinds of businesses, and I was watching your most recent episode with Stacy Raskin. At one point in the interview, Stacy says something along the lines of, quote, "These companies aren't stupid. They see things we don't." And I wanted to push back a little bit on this and maybe tell you about what I'm going through as an employee that is having those tools thrust upon us or provide a skeptic's perspective. First, publicly traded companies and private ones who need to do story time with investors are very interested in expressing their AI investments because investor sentiment is bullish on it. It's that simple to me. I don't think the reality on returns materially bears out as someone who has to use these tools. They are clumsy. They make weird mistakes that we have to clean up. They imagine things. And at the same time, we're being more or less forced to use them, which creates a feedback loop. In plenty of scenarios, they create more work, while here and there, maybe they save a tiny bit of effort. A simpler observation is that in many organizations, especially large ones, hands-on keyboard coding is not where the productivity is often being lost. When I say forced, I mean forced. Line managers are telling employees, quote, "We are tracking your token usage," unquote. If one delicately expresses concern like, "So am I in trouble if I don't feel like the tool fits into my workflow very well?" they'll politely say, "No, of course not. We're all figuring this out together." But also, you're expected to keep using them, or certain types of work deemed trivial mandate you use AI. This week, says Max, I am wasting a ton of time on this for some tasks I could knock out pretty easily, but need to coax the AI tools to do for me. In some cases, I'm hearing not so polite suggestions, i.e., actual mandates from director levels: use this or there's consequences, i.e., reorganizations, micromanagement, unstated but likely firing. I think these internal pressures are creating additional feedback loops in the market messaging that muddy the waters here. Investors want to see action on AI, which helps stocks. Leadership wants to help this narrative, so they do everything they can to force their employees to use it. The companies selling these AI tools also create leadership-oriented dashboards around token spend and autocomplete usage. But there is no lucid objective measure on actual outcomes, i.e., maybe I accepted an autocomplete suggestion as a programmer, but realized a little while later it was a bad suggestion and I have to throw it away and rewrite it by hand. As someone with their feet on the ground here, I feel like I'm living in an alternate reality. It's some really crazy City of Oz stuff to me. It's genuinely a nightmare how leadership demands we shim it into every corner of our workflows in ways that genuinely don't make sense. Teams are incentivized to appear to be AI leaders, so they are spinning up projects that no one truly uses but result in token spend. An absolute top to bottom frenzy of incentives to not live in reality about the tangible outcomes here. When does this really hit? You questioned Stacy for this a bit, and his main response was that it crashes down when these core companies start clamping down on CapEx. But right now, this is all running on an incredible loss for speculative short-term gain, right? When these core AI companies turn around and want to really make returns, and these token costs skyrocket, aren't we going to return to preferring the operational costs of humans in most cases? Especially where it's clear the benefit is marginal, if not imagined. And that's Max's letter. Quite a letter. This letter really leaves open the possibility that at least some of the massive AI capex is hit and miss, with a lot of very expensive misses and a lot of unintended consequences. According to Max, he is working double time to make up for the problems AI generates, and it's easy to assume that companies have cut way back on payroll to justify their huge investment in AI, making people like Max work harder and feel extremely frustrated. Frustrated enough to write this to me. Max is just one person, but clearly he is expressing what he and others are feeling and experiencing. Given how euphoric the narrative is around AI, I felt it was important to share this letter and to follow with a short discussion about youth unemployment and the K-shaped economy. Multiple viewers are asking about what is going on with youth unemployment and what does it mean. Clearly, this is one negative aspect of AI. As I said before, we are experiencing something of a K-shaped economy with all the growth going to AI-related investments. Those expenditures are already having some negative impacts on employment, specifically youth employment. Now, overall unemployment is pretty low at 4.5%, but youth unemployment is 11%. But there seems to be a lot of problems with recent college grads with engineering or computer programming degrees getting jobs. Now, this could simply be the timing of supply and demand, because everyone went to get those degrees just in time for AI to reduce the need for entry-level positions. Anecdotally, kids went into computers because that was where the jobs were. And now, AI has unfortunately done a bait and switch on all these young people, which is just so upsetting. Moving on. Our next mailbag question relates to personal finance. This is from Jared, who says, saving enough money for a down payment on a home has been a focus of my wife and I these past few years. We currently have, and he mentioned amount, I won't mention it, in stocks and bonds. And in another 2 years, we think we will have about 2 times that amount and be ready to put money down on our first home. Do you think that the housing market will be in a good place 2 years from now? Is it too risky to have that money invested in the market during the next 2 years? Thank you, Steve. So congratulations to you both. It's not easy to set aside money and be disciplined about it. To answer specifically, a 2-year horizon is too short to make a judgment call by me or anybody else for either the stock market or the real estate market. So I will take this opportunity to discuss pros and cons of what you're trying to do. Staying in the market gives you liquidity and the opportunity to ride out dips. And over the long term, stocks have proven themselves to be the best risk-weighted long-term investment by far. Housing, in my view, is no longer a reliable investment vehicle and should be bought if it's a good price and it's where you want to live. You might make money if you sell, but I would caution not to expect to make a lot on your home anymore. I think those days are done. Also, housing is by definition illiquid and tends to run in 7-year or longer cycles. So the purchase might be yours for a much longer time than you anticipate. Also, taxes are a key hidden factor in making good decisions for all investments, including housing, and tax shocks can really hurt. My advice is, since selling stocks triggers capital gains, if possible, try and match sales of stocks with equal gains and losses to limit your tax exposure. Now, buying a house, and I know this from experience, has hidden costs and taxes to be aware of, including closing costs, mortgage costs, legal costs, real estate taxes, homeowners insurance, and ultimately all the upgrades the house will need. And I can only say from personal experience, all houses need those upgrades and you will want to make them. One more thought. You should check out the real estate tax situation and the insurance trends where you want to buy. These are both dependent on the financial and physical health of the community you want to live in. School systems matter. Real estate taxes pay for schools, so whether or not you have children in those schools, you are paying more in taxes. It's possible, and you really should think about this, that renting long-term and growing your liquid assets at this time in your wealth-building cycle may be the best answer for you. Next mailbag from Alex. Hi, Steve. I have a question about the CFA exams. I have always wanted to pass the exams. Do you think it is still worth the effort, especially with AI that can probably solve any of the CFA problems in seconds, meaning that anyone can get the needed information from AI? I was just wondering what your take is on the CFA program. Thanks. This is something I feel very strongly about. There is no substitute for learning something yourself. If you want to learn about markets, the CFA exam is a wonderful source. Now, I took level 1 and then I stopped. So if you were just looking for the education and not the degree, taking level 1, I think, is sufficient. I learned a ton about markets and stocks and how to analyze both. It was a real education. Just asking AI a question and getting an answer is not an education. AI might have the right answer, but so what? You don't know anything other than the answer to that one question. Believe me, there is no substitute for learning the material yourself. Also, unless you know the CFA material, you won't know how to communicate with AI in order to get the best, most accurate responses. So my answer again is educate yourself. Next mailbag from Kyle. Does your portfolio recommendation change after retirement from the SPY and QQQ split to something different? What Kyle is referring to was my recommendation in my master class for that most people should just invest in some combination of the S&P 500 and NASDAQ, whose symbols are SPY and QQQ. Answering this question presents something of a conundrum. If you've invested in the SPY and QQQ for years, then you have massive gains, which is a good thing. So as you get older and want to invest in bonds, however, if you sell the SPY and QQQ, you've got a serious math problem. Depending on the state you live in, when you sell, you will pay 30-ish capital gains tax to buy a 6% bond fund. That's bad math. So what I would recommend is that if you have an IRA, when you reach age 73, you are required to withdraw a percentage of your fund every year by law, and you will pay income taxes on that amount. You have to. But then I'd take that money and I'd buy bonds. What kind of bonds? For this money, you want to be safe. So I'd buy US Treasuries or high-grade corporates. If you have a Roth IRA, so much the better. Next mailbag from Dave. Hey, Steve, I love the podcast and appreciate every episode you put out. You're welcome. After speaking with Patrick McGee about Apple's situation in China, how should Apple investors like yourself go about this? Has what you learned from McGee affected your thesis? How does this affect Apple's future in your eyes? Thank you. Now, I posted my interview with Patrick McGee in late May. In the interview, Patrick pointed out that almost 100% of Apple's products are manufactured in China. Now, they might be assembled elsewhere, but they are manufactured in China. So Apple was completely beholden to trade relations between the US and China. Now, since then, a ton has changed. Apple cut a deal with the Trump administration. In exchange for increasing investments in the US, Apple's products will be exempt from tariffs. Also, Google won its antitrust case and can continue to pay Apple $20 billion a year, and that $20 billion has 100% margins. So Apple, which at one point was down double digits this year, is up around 4% for the year at this point. It's had quite a rally. But Apple still lags the market because while things are certainly better, it still does not have an AI strategy. Now, I'll be exploring this very theme in detail in 2 weeks when I drop an episode with Craig Moffett and Michael Nathanson of Moffett Nathanson, who understand the Google-Apple relationship in great detail. And that's the wrap. This week, we dropped an episode with Stacy Raskin, the semiconductor analyst at Bernstein. The discussion was wide-ranging, from the power and reach of NVIDIA to what really caused the collapse of Intel. So check it out. And this Monday, we will drop an interview with Steve Eisman, chief economics reporter at CNBC. Our discussion focused on what's really happening with tariffs, the spotty strength of the US economy, the Fed and its relationship to politics, and Steve Eisman's time and stories as head of the Wall Street Journal's Bureau of Russia during the 1990s Yeltsin era. Hope you tune in. My wife Valerie and I were guests this week on a podcast with our absolute favorite comedian Modi and his husband Leo, and the name of the podcast is And Here's Modi, so check it out. If you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcast and the financial literacy masterclasses. Subscribing is the best way to help the channel, and we greatly appreciate your support. Also, be sure to check out our website, realeismanplaybook.com. There you can easily access all our episodes as well as the financial literacy masterclasses. Check it out and see you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.